Welcome to PhillipCapital Weekly Market Watch. My name is Victor Y from Unit Trust Research. In this week's edition, we are going to look at the key fundamentals which are supporting consumer staple stocks as they hit fresh all-time highs in recent trading days. Year to date, consumer staples are up roughly 18%, while that of S&P 500 paled in comparison with 12% return. First, non-elastic consumer demand. Consumer staples are goods that people are unable or unwilling to cut back from their budgets, regardless of their financial situation. Consumer staple companies typically see their product demand relatively stable despite rising prices. It is all the more important to look at this sector when the economic fundamentals have seemingly decoupled from equity returns. Examples include number one cigarette brand Marlboro by Philip Morris International, Johnson & Johnson, P&G, and Coca-Cola. Second, stable dividend yield. In the context of low interest rate environment, fixed income investors have been absorbing the vast supply of high-yield corporate bonds. Spurred by the monetary policy of the Fed and major central banks, the high-yield space is experiencing continual yield compression. In short, investors are willing to take on higher credit risk or go on longer duration just for the incremental yield. The search for yield may be satiated by looking at defensive non-cyclical companies which have a rich history of stable dividend payout. Most of these companies can be found in the consumer staples sector. Third, portfolio diversification. Systematic risk, as measured by beta, is lower in consumer staples sector than most other sectors. For example, Vanguard Consumer Staples ETF has 0.6 times beta risk, similar to SPDR Spider Consumer Staples Select ETF. While our outlook for equities in 2013 remains bullish, adding the defensive sector to an investor's portfolio may mitigate unwanted downside risk, which may arise from time to time, especially austerity discipline is systematically implemented across the Eurozone. To drive the next wave of consumerism, most consumer staple companies are expanding into frontier markets. For example, Coca-Cola made its first delivery in Myanmar for the first time in 60 years. Unilever aims to change the hygiene behavior of 1 billion consumers in Asia, Africa, and Latin America with its Lifebuoy product brand. Market penetration takes years, especially when changing a consumption pattern. Hence, investors looking for growth in tandem with market cycles would be better off investing in financial or industrial sectors. The defensive and sometimes boring consumer staple sector may insulate a portfolio against market volatility, capable of delivering returns, dividends in good times and bad times. These are the factors driving the outperformance of consumer staples sector against broader market indexes such as MSCI World and S&P 500. Over a one-year period, consumer staples sector gained 30%, while broader market gained about 21%. Across a 3-year period, consumer staples almost doubled 30% return of broader market index. Over a 5-year period, consumer staples sector gained an annualized of 17%, while that of S&P 500 returned a nonetheless impressive 10% per annum return. As can be seen, consumer staple sector is a much overlooked sector, which has been quietly bringing in the returns for investors. Thank you for watching this episode of PhillipCapital Weekly Market Watch, and we'll see you next week.